Hi, Ron Benning here with the Sacramento Duplex 2025 year-end market update. In this video, we'll look at the key trends for 2025 in the Sacramento Duplex market, what the current break-even GRM is for a Sacramento Duplex, and we'll discuss likely trends for pricing, interest rates, and other market activities for the first quarter of 2026. So make sure you watch to the end to see what is most likely to happen. And as always, if you've not already subscribed to my channel, please subscribe now so you won't miss any of my future market updates and cash flow alerts. We finished 2025 in a seller's market for duplexes in Sacramento with 1.8 month supply of inventory, which is down 33.9% from last year and down 30.4% from November. Anytime the months of inventory falls below 3 months, that puts us in a seller market. This is in large part due to the active inventory dropping sharply. Compared to last year, the number of duplexes for sale was down 16.4%, and inventory was down a significant 35.4% from November. When we look at the month's inventory based on pending sales, the number came in at 2.8 month supply. That's down 9.8% over a year ago, but up 21.5% month over month, which means that although inventory has fallen sharply, that pending sales have fallen at an even sharper rate. There are 18 pending duplex sales in December, which represents a 47.1% drop from November and a 10% decline compared to last year. This sharp drop in pendings is important. It suggests that while inventory tightened and sellers gained leverage, buyer activity cooled noticeably heading into the holidays. This is one of the first signals that buyers are not happy with the status quo, as can be seen in the large expectation gap. Let's take a look at that expectation gap. The average for sale price in December came in at $702,000, which is up 9.3% year over year and up 2% from last month. But the average sold price was $604,000, which is down 1.8% from last year, but up 3% month over month. This growing gap over the last year between the average list price and sale price has got me concerned. What this tells me is that sellers are continuing to push up prices higher while buyers are selectively paying up only for properties that are priced realistically. That growing expectation gap increases the risk of longer days on the market, more unsold inventory, and a larger correction at some point in the future. Now looking at closed sales, December had 28 closed duplex sales, which is up 21.7% from December of last year, but down 6.7% from November when we had 30 closings. So even though sales dipped slightly month over month, the year over year growth tells us that buyer demand is still meaningfully stronger than it was last year at this time, but with rapidly weakening enthusiasm. So we have fewer listings, fewer pendings, and slightly fewer closings. This tells us that the market is tightening primarily due to reduced supply, not accelerating demand. The average days on the market for December was 43 days. That's down 14% from November, but still up 72% compared to last year at this time. This tells us that well-priced duplexes are still moving, but overpriced listings are sitting, even in a seller's market. The buyer bargaining power has tightened back up. The sold to original list price ratio came in at 97% this last month, which is up 1% from the previous month. That translates to roughly a 3% buyer negotiating power on average. Even in a seller's market, buyers still have a little room to negotiate, especially on properties that have been sitting on the market for more than 30 days. Assuming a 6.5% investor interest rate and 25% down, the current break-even GRM for a duplex at the end of December was approximately 12.41. That means deals must be priced very efficiently to cash flow from day one. And looking at recent sales, there were still duplexes trading at or below this threshold, but they were the exception, not the rule. GRM discipline matters more now than almost any point in the last few years for duplexes. Next, let's talk about interest rates. As has been the case all year, interest rates remain one of the single most important drivers of the market going forward. Right now, investor loan rates for fourplexes are going for about 6.5%, which is always a little higher than the base rate on the Freddie Mac chart we show you. But looking where rates were at the beginning of the year, we can see that rates came down just over 0.75% in the past year. Despite this, we still see that prices have been coming down slightly. I'll talk about that in just a minute. Over the next few months, rates will likely remain fairly stable, but a great deal of what will happen with interest rates is depending on what happens with inflation over the next few months. Before we move on, it's important to step back and put interest rates into a broader economic context, especially as we close out 2025 and head into a new year. Inflation has been one of the biggest forces shaping interest rate policy this year. In 2025, the U.S. inflation rate fluctuated between 2.3 and 3%, and the most recent official reading came in at 2.7% year over year. That's meaningfully lower than where we were a couple of years ago, but still above the Federal Reserve's long-term target of 2%. Looking ahead to 2026, most forecasts are calling for inflation to moderate gradually but not disappear. Current projections generally put inflation somewhere in the 2.4 to 3.1% range during 2026. In other words, inflation may ease a bit, but it is not expected to fall fast enough to justify dramatically lower interest rates. That brings us to the mortgage rate expectations. Several major institutions have published their outlooks for 2026. Fannie Mae is projecting the 30-year fixed rate to gradually decline and end 2026 around 5.9%. The Mortgage Bankers Association expects rates to hover closer to 6.4% for much of the year, while the National Association of Realtors sees rates stabilizing near 6%. What all of these forecasts have in common is that none of them are calling for a rapid return to ultra low rates. That's an important takeaway for investors. If rates drift down slowly, it could support demand and help inventories tighten modestly. But unless rates fall more meaningfully, affordability and cash flow constraints will continue to cap pricing and may make the market sensitive to even small rate changes. So where does this leave us heading into 2026? Inventory is tight, but buyer demand has cooled. Prices are holding up, but only for well-priced properties. Rates are stable, but not low enough to fuel another surge. It is a matter of concern that the average list price over the past 12 months has risen 9.3%, while the average sale price has gone down by 1.8%. This is nothing more than wishful thinking on the part of these sellers, probably because sellers believe people will overpay because of less inventory. But recent history says otherwise. The larger this expectation gap becomes, the higher the chance of a larger market swing. Another important fact to consider is that the rental market has softened over the past year in Sacramento, with a typical two-bedroom duplex renting for between $100 and $150 less per month than last year at this time. So buyers need to be careful not to get too optimistic about large rent increases in the near future. If rates stay where they are, I expect continued tight inventory, moderate sales activities, and a longer days on the market for overpriced listings over the next couple of months. Over the next 45 days, I expect to see a seasonal uptick in inventory start to happen. If rates rise, this seller's market could weaken quickly, particularly if inventory creeps back up. If rates fall meaningfully, inventory could tighten even further. Final thoughts. For buyers, opportunities still exist, but only if you stay disciplined on pricing and a solid initial GRM, or focus on the long-term play of buying a property with low rents at a discount and value add the rents over time. For sellers, pricing strategy still matters, as is evidenced in the large and growing expectation gap between the average list price and the average sale prices. With a weakening demand despite the lowest interest rates in the past couple of years, some sellers who are not realistic about pricing will simply be left behind. If you'd like my weekly GRM report or a property evaluation or rent analysis on your property, scan the QR codes on the screen or check the links in the description below. And whether you're planning to buy or sell in the next 7 days or 7 months, give me a call or a text. I'd be happy to help you plan a smooth and profitable real estate transaction.